ICAI sum number 2, January 2021. This was asked for 10 marks. The capital structure of PQR Limited is as follows: 10% debentures, 12% preference shares, and equity share capital is given. Additional information: rupees 100 per debentures redeemable at par has a 2% flotation cost and 10 years of maturity. The market price per debenture is 110. Rupees 100 per preference shares redeemable at par has 3% flotation cost and 10 years of maturity. The market price per preference shares is 108. The equity share has rupees 4 flotation cost and market price of rupees 25. The next year expected dividend is rupees 2. Next year expected dividend is D1 is 2 with a growth rate of 5%. The firm has a practice paying all the earnings in the form of dividend. Corporate income tax rate is 30%. Required: calculate weighted average cost of capital using market value weights. Try to concentrate. Whenever we find out cost of capital, we consider market value. If we want to find out a futuristic cost of capital, say we are going to borrow money in near future, then we find out that futuristic cost of capital. Another is historical cost of capital. Say by taking market value weights, that does not mean we cannot find out historical cost of capital. So for this question, we may assume this, but try to understand to match the answer with suggested. I am assuming this. While calculating cost of capital, I will not consider market value. Let me start with debt. They are redeemable debt. How to find out cost of redeemable debentures is I into 1 minus T plus RV minus B upon N upon RV plus B upon 2. What is interest in case of debentures? They are 10% debentures of rupees 100 each. So 10 rupees. What is tax rate? 30%. So 1 minus T will be 0.70. Plus they are redeemable at par minus what is borrowing as far as debt is concerned. 110? No. For the purpose of calculating the cost, instead of borrowings, instead of current market price, I will be taking historical price, which is face value. And there is also a flotation cost. So B, instead of taking 110 minus 2%, I am taking 100 minus 2% is 98. Divided by 10 upon 100 plus 98 divided by 2. There is a 7 plus 0.2 upon 99. Which is a 7.27. What is this? Cost of redeemable debt. Let us go to next, which is preference shares. Cost of redeemable preference shares is dividend plus RV minus B upon N upon RV plus B upon 2. Debentures are 12% on rupees 100. So 12 rupees. Plus redemption value is at par 100 rupees minus borrowing. What can be borrowing? You can take 108 rupees. Instead of 108, I am finding out historical cost of capital, so I am taking 100. And borrowing in preference shares will be 100 minus what is the flotation cost is 3%. This is 97 upon 10, 100 plus 97 upon 2. This will be 12.3 divided by 98.5, which is 12.49. Will be cost of preferences. Equity. I will be using dividend model with growth. KE is equal to D1 upon P0 plus G. Here D1 is given to P0 will be 25 minus 4. 25 is market price minus 4. Here we cannot take face value. 21. 2 divided by 21 plus growth rate is 5%. $14.5. I have got cost. Let me find out market value. How many number of shares are there? There are 50,000 shares of rupees 25 each. $12 lakh 50,000. Market value of preference shares. There are 2,500 preference shares of rupees 108. This will be market value of preference shares. 2,70,000. Market value of this will be 3,000 into 110. So I am having cost, I am having market value. I can take cost as I, market value as weight, and I can find out sigma IW divided by sigma W. I am directly doing it in Excel sheet. In your examination, you will have to do manually. Equity cost is 14.52. There are no reserves. Preference shares are 12.49. And debt 7.27. Market value of I think I have written it incorrectly. This is of equity. There are 50,000 equity shares of rupees 25. This is of preference shares. And this is of debt. Let me once again verify it. Debt is the 3,000 into 110. Okay. Preference is 2,500 into 108. And equity is 50,000 into 25. Yes. So equity will be 12 lakh 50. Preference will be 2 lakh 70. And debt will be 3 lakh 30,000. I will be directly getting answer of sigma IW divided by sigma W, which is a 12.93. So my KO sigma IW divided by sigma W is 12.93%. The question arises, and this is one of the most difficult question faced by the student is, sir, why even if market value is given, Why we are not considering that market value over here in borrowings? How I found this out? It is 100 minus 2%. This is 100 minus 3%. Why? What is market value of debentures? Debt is 110. Why I cannot do this? 108 minus 2%. Sorry. Why I can't do this? 110 minus 2%. Or 108 minus 3%. You could have easily done it. You can do this. But believe me, I tried to solve the question by this, by considering market value. In one of the answer, I got a negative cost of capital. The numerator became negative. And so, practically in your examination, you will have to solve this type of question by this method. I have seen n numbers of suggested question which considers market value. So, as a student, do not get confused. If by market value you are not getting answer, immediately shift of finding out on historical cost basis. In finding out cost of capital, don't consider market value. Consider only book value or the face value and find out the answer. And if you are using market value and if you get the answer, get positive answer, then you can continue with that. 100% marks will be awarded to you. Many of the students ask me my opinion. As per my opinion, you should always consider market value, or finance is practically a decision making subject. If you are going to find out your cost, basically it is for decision making, and decision making will normally happen for the future. And if it is going to happen for the future, you should consider market value of the debt and preferentials rather than the face value, as we have done in this question. This is, I think, not incorrect assumption. This is historical cost of capital, but in practical life, majority of times we will be considering market value. We have done a couple of questions of YTM method. In that method, you will have to take your price borrowings as a market value, and you cannot find it out by book value as far as YTM method is concerned. So, sir, the answer is incorrect. No, the answer is not incorrect. Many of the questions are solved based upon book value rather than market value.